Well, good afternoon. Thanks for tuning in to our interview today. My name is Ivy Wong Flores. I'm part of Nuveen's institutional relationship team focused on endowments and foundations. Thanks to Grace Reyes and Tide, which is the Investment Diversity Exchange, for today's opportunity to spend some time with Jim Bethea. Jim is the Chief Investment Officer for the University of Iowa Center for Advancement, or the UICA, and overseeing a total assets of approximately 2.5 billion. Welcome, Jim. Thanks for your time today.
Yeah, thank you.
So, Jim, just to kick things off, the pandemic has impacted pretty much every part of our society, including colleges and universities. Tell us a little bit about what it's been like at the University of Iowa. Are students back on campus? Are expected to come back on campus? Give us a sense of what it's been like where you're at.
Students graduated and were done for the semester about 3 weeks ago. They were on campus. I think it was 60% of the classes were online. So labs, things like that were in person, but classes maybe larger than 50 were all online, and students had the option to be online. We're part of the university. We're the foundation, so we're an affiliate of the university, but we can operate a little bit differently. We've been back in our building. You can be back in the building. You don't have to be effective January 1. Students are expected when they come back in August. They might have to wear masks, but they're going to be in class.
You actually just mentioned how you started taking in-person meetings only recently. And so everyone's had to adapt to this new virtual world over the last, 15 plus months or so in terms of doing our jobs and what it's been like as things kind of reopen, going back into the office, like you mentioned. So what do you think are some things that might change more permanently or kind of stay longer term? What do you think there?
At the beginning, you'll probably see people continue to do some Zoom meetings, due diligence over Zoom, and maybe the final meeting before you decide to do an investment, do that in person. But I think that'll change pretty quickly. I think there's a lot of people itching to travel. There's a couple conferences in the fall, a couple of our annual meetings in the fall that are in person. We've heard a lot from our GPs actually that they really want to see the limited partners. And I think they're driving it more than the limited partners are driving going to an annual meeting. From our perspective in Iowa City, I'm based in Iowa City. One of my teammates is in Des Moines. It's a better airport to travel from. So if I want to go to New York, I burn a day going to New York. He can take, I think, a direct flight to get to New York. And so for me, if based in Iowa City, I don't know if I'll travel as much because I'll try and do more Zoom meetings because I can hit every annual meeting on Zoom. I can't necessarily do that if I'm traveling. So I think it'll be interesting to see how that evolves. From an ESG front, it doesn't make a ton of sense to be flying all around the country visiting all your managers. So if ESG is really going to take hold, I think that's low-hanging fruit to do that. But we don't typically get a lot of managers to come to Iowa City because it's so difficult to get here. And we'd rather them out there doing deals, evaluating companies rather than visiting people like me in far off places.
Yeah, no, that's definitely kind of what we're seeing, whether it's from, survey results or just casually asking, what people are planning to do in terms of manager meetings going forward. There's definitely just an increased interest in at least having some flexibility and having less in-person meetings, especially the not so efficient ones and just flying across country or even to other parts of the world to spend that kind of time but having the ability to do some of those activities virtually. So that definitely makes sense.
One area too that I was kind of surprised, our investment committee, which has been meeting virtually over the last 15 months or so, really every other year we typically do an in-person meeting in the summer, and they expressed a desire to do it this summer, which was off cycle. So they really miss seeing each other, miss seeing the investment team. So that was kind of a surprise.
It sounds like it would have been the 2020 summer that you guys would have met in person. Yep. And since that was canceled, so now they're kind of jumping ahead by 1 year to meet in person. Does that usually happen in Iowa City, or is there different location changes year to year?
Yeah, we typically do it in Chicago just because it's a little bit easier to get to for,
Sure.
we have managers come in, managers in our roster will come in, not talk their book, but talk about trends that they're seeing. It's a lot easier to get them to come to Chicago. So we typically do it in Chicago. The interesting thing about that is that we usually use office space from a vendor that we have in Chicago.
Mm.
They are closed until January 1st. So now we're
Oh,
having to figure, we're planning it now, and we're trying to figure out if we can fit 17 people in a 12-person conference room that we have access to, or if we do it in Iowa City, where because we control the conference rooms that we can use. So we're going through that right now. Our committee wants to get together, but it's so much easier to fly to Chicago. The extra flight to Iowa City, maybe they don't want to do that. And it's a little bit, donor or alums like to visit campus when students are here, and there's not as many students here in the summertime. So we're trying to figure that out actually right now, is where we're going to have it. My vote is always to have it in January, February in like Naples, Florida, but I always get overruled.
oh, I was gonna say January, February in Chicago, maybe not
Yeah,
so
no.
not so popular. Well, speaking of your investment committee and the teams getting together, maybe a little bit background on yourself, Jim. Over your career, you were in manager research at a consulting firm, an analyst covering M&A buyouts, and even an engineer by training,
Yep.
as I hear, and now the CIO for the past 11 years. Tell us a little bit about your career path. What are some reflections maybe you've had over the various transitions in these roles? And was there a pivotal moment or person or people that kind of came along that kind of, directed you a certain way? Share with us a little bit about kind of what that path has looked like.
I always enjoyed math and science, so I majored in mechanical engineering, and I went to Ohio State, and a lot of people would start out in mechanical engineering and then they get to like calculus or physics and transition into business. So I was just adamantly opposed to doing that. So I became an engineer, did that for 5 years. And my dad, growing up, on Friday nights, he would always have us watch Wall Street Week and McLaughlin Report. And I would always hate like how old these people all are, but it was interesting to see. And I actually then would meet some of the people that were on with Louis Rukeyser in later in life. So that was pretty interesting. But I remember being in a meeting where I was working for Bridgestone at the time, and GM was making an announcement that we were one of their suppliers of the year. And the individual was a CFO or something at fairly high up at GM. And I was 20 something at the time. He appeared to be 30 something at the time. And I'm looking around at all my fellow engineers who were 40 to 50 something. And that was kind of my career arc, was just to continue to be an engineer. And I'm looking at them, and I knew what that life would be like. And I'm looking at this 30-year-old guy that's like, he's a C-level person at a huge company. I'm like, maybe the business I missed something by doing that. So I started going to Case Western Reserve University part-time. And then a buddy of mine who's a CIO down at a family office in Dallas and was working in a family office in Cleveland at the time, also started going to Case. And I decided to just go back full-time. So in August of 2001, I decided to leave my high-paying engineering job to put all my chips on the table towards moving into the investment world. When I graduated, I was one of 25% of my class that had a job, because 2002 was not a great year to graduate. And I was fortunate enough to get a job with Mystic Capital doing kind of investment banking, insurance brokerage sector, which is really similar in many ways to manager research. You're interviewing the C-level folks, seeing if it makes sense. Like, does the qualitative stuff and quantitative stuff match? The spreadsheets match what your interviews are. And so that was really interesting. And I learned a lot there. I was traveling a ton, and I got married along the way. And my wife was like, can you dial back the traveling? So I liked the investment angle more than the investment banking angle of that job. So I moved into manager research at a sub-advised mutual fund shop. It was in Cincinnati. I think we were living at the time. And did that for a bit and really enjoyed the manager research aspect of it. But a mutual fund shop isn't hiring and firing a ton of managers that often. So it was more like a maintenance of the funds and
Sure.
helping explain the story of the funds rather than
Mhm.
do we have the best manager, which is how an endowment would invest. So I was anxious to get out of Ohio at the time. I had lived my life in Ohio, and my wife had a few cities that she was willing to move to, and Portland, Oregon was one of them. So got a job at RVK in Portland and did manager research there on more. I think I was doing small cap, US and international and emerging markets. I can't remember what else I did there. And so that was great, getting to meet the different types of clients. And I think everybody in manager research, they might not admit this, but everybody in manager research probably thinks about going to work for an institutional investor, whether that's a pension fund or foundation endowment. Family offices weren't really a thing 11 years ago. And so I kind of knew that maybe I'd do that one day, but I never really knew when I would do it. And it just so happened that the University of Iowa, then it was the University of Iowa Foundation, but they were looking for their first investment person to start there. And it was kind of a blank slate because they didn't know if it would evolve into a CIO or what they needed out of the job. But they had really changed their asset allocation and needed somebody to come in and kind of spearhead moving towards that new asset allocation. So I wasn't looking for a job back in 2010, I guess it was, but fortunate enough to get the job at Iowa.
Well, thank you for that. Go Buckeyes.
That's right. That's right. Although I should say go Hawks if anybody from Iowa is listening.
Yes, and Hawks. Thanks for walking us through kind of that path. Very interesting. And interesting, you mentioned kind of you were the first dedicated investment person for the foundation at the time. So give us kind of a brief overview of what the foundation and I guess UICA, kind of what this entity is about, the types of assets that you're overseeing, and maybe just a brief overview kind of how you think about the portfolio, just given kind of the evolution in the past, decade plus.
Yeah, so when I started, we were 585 million in support of the University of Iowa. Today, the endowment's 1.2 billion in support. And so what's changed for the most part is when I started, we were kind of changing a portfolio that during the global financial crisis was 80% US equities and 20% US equity, or I'm sorry, US fixed income.
Sure.
And so we wanted to diversify the portfolio. And at the time I started, the diversification had been to 65% US equity. So we had done some international, some emerging markets, and I think some REITs. And it just before I started, made our first commitment to it was a private credit fund, I think was the first one. I can't remember the asset allocation that we were trying to get to at the time. It was maybe 15% private equity, probably 10% long short equity, some real assets. And what we call diversifying strategies would be kind of like multi-strat hedge funds, royalty investments, I hate to say uncorrelated because nothing's uncorrelated, lower correlated assets to equities. And so since then, we've evolved to today, we're about 18% private equity. Overall, I think it's 45% private hedge funds, where I think there's 3 in the portfolio. It's probably about 3%. So as we evolved the portfolio, we didn't really need the hedged equity anymore because that was really there to help mitigate the volatility of equities. And we get a lot of that just from private equity not marking month to month. That's not why we do private equity, but that's certainly an unintended benefit maybe of private equity.
It's probably a natural segue to kind of some kind of key areas that Nuveen, which is part of TIAA, we partner with NACUBO to do the annual NACUBO TIAA study of endowments every year, and the several topics that we have, including asset allocation, performance, returns, and also ESG DEI. So maybe we'll touch on each area of those, which we already started to do in terms of looking at how the asset allocation in the portfolio have perhaps evolved over time. Maybe specifically, how do you think about long-term investment objectives versus short-term needs such as liquidity in a year like 2020, when you do have 45% in privates, and what does that mean from both a long-term as well as short and medium-term outlook?
Yeah, so what's interesting about UICA is we spend about 4.5% each year. So 4.5% of the endowment goes to campus. In a normal year, so non-pandemic year, we get about 4.4% of the endowment in new gifts. So from a liquidity standpoint, if we had 1% in cash, that's 10 years worth of liquidity. So we are different than some, every endowment has the same return objective, but that liquidity aspect is vastly different based on what their development teams can do. If you don't have great development, your portfolio isn't nearly as liquid as our portfolio is. So where we were stretched a bit last year wasn't in like new gifts kept coming in, pledge payments still came in. Where things kind of took a little bit of a dip were in new gifts. And so that won't really be a problem from our perspective, from a liquidity standpoint, unless it persists for another couple years. So next year, this next fiscal year, it could reverse itself and everything's fine. But so from our standpoint, the private capital hasn't affected the liquidity needs of the endowment because we keep getting new gifts in. Now, couple that with, like I mentioned, we don't have a lot of hedge funds. So basically we're 45% maybe private capital stuff. I can't remember if it's that high, but let's call it 45%, 3% in hedge funds, and then 52% would be in stuff that has monthly liquidity. So still, even given that 45% number, we're still massively liquid. And again, we don't really need that liquidity. So we haven't felt the pinch really of the liquidity yet. Even last March, it really wasn't that big of an issue for us either. We were able to generate whatever we needed for payout. But from your question on the return going forward, we do think that probably like every other endowment, which is scary to me, if everybody thinks private equity is going to get them the returns, then private equity is not going to get anybody the returns. So we do look to do things that are a little bit different in private equity. So a lot of the funds that we're investing in are fund ones, fund twos. Every fund that we invest in, I shouldn't say every fund because there's one fund that we did last year that wasn't this way, but in private equity specifically, every fund is under $1 billion. In private capital, that's not always the case. It's generally the case, but not always. I think the smallest fund we've done, we did a $10 million commitment to a $150 million fund a number of years ago. We've done a couple sub $200 million funds with maybe larger commitments since then. But we'll do smaller funds and we will basically kind of re-up if everything's going according to plan until they get to $1 billion. And we tell them at the outset, once you cross $1 billion, we think the GP-LP alignment's changed. And they're all going to tell me that that's not the case as they have their third and fourth vacation home. And I'm sure it's not the case. You need those extra vacation homes. We just think there's
for example.
What's that?
I said in Florida, for example.
Yeah, you got to have something warm. So we that's kind of how we differentiate ourselves. And when you're doing those smaller funds, there's not a lot of room for 10 other endowments to be in those funds, because if it's a $300 million fund, 10, 11 endowments could take up the whole thing. So we're in with a lot of family offices. So we talk with family offices about pipelines. We talk to our endowment peers too, but we find that endowments say they like smaller funds, but what they define as small is what we define as large.
Well, you kind of started talking about one of my other questions is actually, as part of the NACUBO TIAA study, as you know, it's broken down by size of endowment. So you guys certainly fall under the, larger than $1 billion in size. It's interesting you mentioned, just given on the PE side, your tendency to look for kind of smaller PE funds. So maybe just to expand a little bit, do you see certain challenges? You mentioned some opportunities that's based on kind of your size or governance structure or otherwise that you want to exploit or that you see are important for managing the UICA portfolio.
one of our investment committee members was at a large 5 billion plus PE shop, and he kind of helped. He's been a mentor to me to help frame my thinking of private equity. And I'm not opposed to those. They have their place, but I don't know if they're worth 2 and 20. They're not making the operational changes that some of our funds are doing. And I think that's where we have a good edge, is figuring out if the teams, because if you started a large fund, you're one partner at $1 billion or a $10 billion fund, and you say you look at your returns, you're like, my returns are great, my deals are killing it, but the partners with their names on the door, their deals are horrible, but my carry's based on the fund overall. I'm going to go start my own shop. And that's great, but you got to realize you're the fundraiser now. You're the CEO of an organization now, and that's different. You didn't have to do the HR stuff when you were a part of a huge investment behemoth. And so I think we have a pretty good edge in when we interview GPs to get to see if they really understand that. Now, I would guess that every LP you talk to thinks they have an edge, and we can't all have edges. But I think we do a pretty good job seeing if they understand the cultural aspects of what they're doing. Are they building an investment culture, or are they just trying to raise a fund? Because a lot of people just try and raise a fund. That's really different. And do they understand what it's going to be like? They might have had to deal with 2 or 3 portfolio companies during 2008, but do they know what it's going to be like to deal with 10 to 15 and a firm? When the firm isn't necessarily paying out carry, and they might have to raise a follow-on fund and nobody's received carry, what do they do? And really ask those questions about, is the GP commit coming from hard dollars, or are you using my money as fee offsets? And do they understand how I think about that? And so what we found with the small funds is, as a smaller investor, because we are in the billion plus Nakubo peer group, but in the kind of global institutional investor peer group, we're pretty small at $1 billion. That's not huge compared to pension funds. So if we're investing in a $500 million fund, and let's say it's a $15 million, $20 million commitment, I'm getting the GP on the phone anytime I want, and they're going to return that call same day. They're going to see what I need. If I'm investing in a $15 billion, $5 billion fund, I'm going to get somebody that's going to have, it's like the telephone game of information. I'm not going to get firsthand account. And so we found, as a small team here at UICA, we need that information from our GPs, because that helps us frame, if years ago, all of our GPs were telling us in the manufacturing world, it was really hard to hire people. People like me wouldn't be getting interviews at an oil and gas company because I shaved my head, and they do drug testing through hair. That's why Britney Spears shaved her head. That's good information for us. And if we're still looking at the manufacturing sector, industrial, what does that mean for the Midwest, which is primarily manufacturing? And that helps frame our thinking, not necessarily in their fund, but if we're looking at a different fund in a different sector, that might help frame that thinking.
It sounds like your background in M&A and manager research is all coming together in your role as CIO. Going back to the topic of spending and how you as an allocator think about managing over the long term, there's still kind of typical kind of 5% spending rate plus 2% inflation hurdle, call it 7% return target at a lot of endowments, and quite frankly at pensions as well. So this kind of elusive 7% return hurdle over time. And I noticed the 4 policy buckets that you have in the endowment across global equity, fixed income, real assets, and diversifying strategies. What are some of the areas that you're spending the most time on today? What are some of the key concerns you might have in these different buckets? Share with us some of your insights and things that you're talking to your managers and your team about.
Sure. Fixed income's less of a area of concentration right now, just because I don't know how you get returns out of fixed income. Real assets is, I think people think of real assets historically as an inflation hedge, which I would argue that is absolutely false. I can go on a rant for an hour about how nothing's an inflation hedge except maybe stocks. It's really what happens when people say it's an inflation hedge, they don't follow up with data that suggests that the correlation between the investment they're talking about and inflation is, I've seen information where 0.4 is an inflation hedge. And I would argue with that person that like 0.4 is also defined as uncorrelated. So it can't be both.
Not statistically significant.
Exactly. Like I remember there was one phone we were looking at where they showed R squared. I don't think enough people know that R squared is just correlation squared. You can hide the number like R squared. That 0.5 R squared sounds great, but like that doesn't mean it's that great. It's 0.7 something, 0.70 something. I can't remember from a correlation standpoint, but it's a way to hide it. And like, oh, R squared, yeah, that's great. How many people actually know what it means? That's kind of the engineer in me. I took statistics way too many times to.
Yeah. I was gonna say it's that education at Ohio State.
I'm a bit skeptical. I'm not saying that you shouldn't do real assets. I look at them. I explained to our committee, an oil and gas fund, it's just private equity. It's just energy sector private equity. Think of it that way. Don't think of it as an inflation hedge. And so we're not spending a ton of time in real assets, primarily because we don't think it's an inflation hedge, but we're also trying to kind of get our arms around the ESG angle of it. And we can come back to that if you want. Where we are spending our time would be on private equity, because I don't know if we have enough data points where it's skill or luck, but we have outperformed our public market equivalent by several hundred, 300 to 500 basis points, although not over the last year. Nobody's outperformed the public markets over the last year. And so we've done really well there. And so we're leaning into that for as long as we can to help offset some of the return issues that you're kind of talking about going forward. Our returns fiscal year 2020 were horrible, and we spent a lot of time figuring out what went wrong. And a lot of that, we think we understand what we did there. And I wouldn't say it was a value bias necessarily that caused that, but there's probably 3 or 4 things that caused it. And we didn't see all these things going wrong in the same year. Another area that we think we have some insight is on the diversifying strategies bucket. We were early investors into royalties. So we did oil and gas and wind royalties, music royalties, healthcare royalties. I would say that music royalties are pretty common now. They're maybe a little bit stretched in the interest level. There's a lot of interest from allocators in there, and there's a lot of capital being raised, which concerns me. There was a SPAC that bought some music stuff last week or so. Anytime a SPAC's involved, I'm a little bit scared. So the one thing that probably keeps me up at night as a long-term investor in private is that the returns won't be there. And then we're locked up for, 6 to 10 years more in something, and we could sell it. We had discussions about, should we sell our energy holdings last summer, and the prices you get bids on, no one was going to sell for those prices. So that's my concern, is that everybody in the world thinks they're smart, and everybody in the world's doing the same thing. Just logically, it doesn't make sense that that's going to work out.
Everyone's going to, their approach is going to all work out because
I mean, that's ultimately the problem people had with hedge funds, is everybody piled into hedge funds. Well, hedge fund return came down. Well, everybody's piling into private equity now. And when you talk to people about it, like, I think the return is going to be there because all we do is hire top quartile managers, and it's like a Lake Wobegon.
Do you believe in kind of that 7% target? Is it still realistic? I'm trying to get a CIO to answer that question.
Is it still realistic? On the record, is it realistic, or off the record? Is it, I think it is realistic, not for everybody. And so I think, while again, every allocator is going to say it's realistic for us, but no, the whole world not. From our perspective, like our spending policy, the way it works is it's a constant dollar amount during the fiscal year. And so as long as returns are higher than inflation, the spending rate goes down. And so unless we get into hyperinflation this year, our spending rate should go down. If returns are like 30%, they better go down. And so we're taking care of it that way, although it takes a long time for that spending rate to really come down. I think inevitably you have to see people lowering their spending rate, or if you're a pension fund, lowering your assumed return. I think pensions have it harder because there's a lot of politics involved in if they lower their assumed return rate, in that the government's going to have to pony up more money, and governments don't want to do that.
Mhm.
I think that gives endowments a little bit of a backstop, and they can look like, look, the pension funds, they're bigger than us. If they think they can do it, we think we can do it. It isn't a great answer for an endowment to say that. I can't think of anybody specifically, but there's a couple endowments that instead of a 5% of a 12-quarter moving average, they've lowered that to 4, and some are thinking about lowering that to like 3.5. And
Mhm.
really, we did some analysis on that. And if you don't lower it to a 3 handle, you're not really doing anything. You're making people feel good. Rate is lower, but it's not really lower. To your specific question, do I think we can get the 7%? Like based on Iowa's up MIFA law, I have to invest that way, or I'd
Sure.
have to lower my spending rate. And I think that we can. At some point, they have to raise interest rates, and that's going to make it a little bit easier. So that might not be in my lifetime, but over the next 50 years, is 7% doable? Yes. Over 10, I don't know about that.
Just because inflation has been so topical and you've even mentioned it in your own response, just really quick thoughts on inflation, whether it's transitory or not. Is the Fed kind of communicating and being persuasive in what they're communicating? What are your thoughts there?
I think Dion, he used to be at Axios, but Dion Raboin would always state what causes inflation is people thinking about inflation. And so if that's true, we're going to have more than transitory inflation. Everybody's talking about inflation. So I'll put it
Mm,
to you this way. If you went to your customers and said, what do you think about inflation? Like, would you accept prices increasing? And they said yes. Any good business owner is going to increase prices, right? Like, oh,
yeah.
they've just said they'll accept increased prices. So you're going. So I think inflation does cause inflation,
Mm,
or talking about inflation causes inflation. I think that's
mm,
what you're seeing in the labor market. Why
mm,
4 million people left the labor force last was a week or month, I can't remember. They left because they think they can get the same paying or better paying jobs when they want to come back. And that's
mm,
not, great for prices because they're going to have to
mhm,
pay people more. So I
mhm.
think we're going to see elevated levels, and I say elevated from the 1.5% that we've seen over the last decade or so.
Sure.
It'll get higher than that. 3 to 5%, I could see. If it gets over 5%, you're going to see panic in the streets, which doesn't seem like that high, but
Well, that's high for those of us that have lived through the last, what, 30 years,
yeah,
right?
it's high for that. But if you compare it to like the 70s, I don't think it was that high. I mean, the 70s had a lot of inflation, like particularly the
Mhm.
late 70s. How they fought that, they raised interest rates. So if they raise interest rates, it's easy for me to get 7%. So everybody wins.
Let's hope there's some balances in both on the fiscal, monetary, and kind of from a mark asset pricing perspective as well. We recently had an inflation webinar for kind of the ENF audience, and at Nuveen we have a commodities specialist called Gresham, and so commodities is all they do. And our panelists there kind of laid out the 4 areas or framework to think about inflation. And what you highlighted is that behavioral aspect of inflation, on top of what's happening on a political aspect as well as monetary and fiscal. So it'll be interesting to see what you pointed out. If people are expecting inflation, that would be a big driver of inflation actually going up or not. So,
Yeah, I heard that specifically on lumber prices, and that lumber
mhm,
prices went through the roof, doubling, I think, what the cost of a 2x4 was. And if you're Lowe's and you basically primed people to pay more for a 2x4, if
mhm,
prices go down, why wouldn't you just keep charging them or just give them half the cost back? People that buy lumber for home improvement aren't going to see what the cost of the commodity price of lumber is. They're just going to buy what they need to buy.
mhm,
So
mhm.
I think
Yeah.
some of that's permanent.
To your point, if you're a good businessman, right? If your customer is willing to pay more, why would you
Yeah,
offer it for less?
yeah.
Another topic, and you already mentioned this, is around ESG. And certainly we're seeing that across not just the public markets, but across all asset classes and broadly beyond ESG. On the environmental side, you're also hearing a lot about diversity, equity, and inclusion. So DEI. Can you give us thoughts there about from a university perspective as well as from the endowment portfolios perspective, if you guys have integrated that, if you've implemented that into your investments, what are some of the things that you guys are talking about with regards to ESG and DEI?
We've been a little bit slow to add ESG to our investment policy statement, to put it in writing. It's kind of there in the background. So we're going to get that into our investment policy statement. We revise that every October. So we'll get that in there this year. We did a lot of wind farm investments. The returns were great there. I don't think we did it from like an environmental, we're helping the world type thing. We looked at it from a return basis, and Iowa is one of the, I think it's the second largest wind producing state. It's one of our only natural resources. We're the only state that doesn't have any oil and gas underneath it. And so we didn't do it from that perspective either. We just thought it was an interesting return stream. We're looking at other renewables, other ways to invest in renewables, but also the building blocks of things that go into renewables. So renewables use a lot of metals, copper, gold, nickel. And so those things have to come out of the ground in a responsible way. And so we're trying to partner with people that will think about, kind of joke with them, like, you're ripping stuff out of the ground. Like, you can't say it's friendly, like it could be better, but it's not friendly. But partner with people that do it in a responsible way and think about how they're treating the earth and the people in the communities that a lot of these are poor nations that have some of these metals. And so how are they treating those folks? Thinking about that, Elon Musk made a comment about like crypto I think it was specifically Bitcoin. It's too high priced because it destroys the earth because of the like oil and gas that's used to power the miners. Well, those same resources power his cars. Like most of the energy is still fossil fuel energy. And so you have to partner with folks that do that in a responsible way. And one of the ways that you can gauge, I think, if these companies are responsible from an environmental standpoint, like, is it lip service or is it real, is how they treat their employees. Do they emphasize an inclusive and diverse workforce? And if they don't, then chances are it's just window dressing and what they're telling you. Good to great basically says good companies that hire good people will have better performance. And I think there's a lot to that. So I think from an allocator standpoint, the quantitative information that we all get is a commodity. Like, every fund's top quartile, we all know that. Like, that's all like baked into the, where we, I think, are spending time is getting to know the culture. And so asking them around this time last year, when I think there are a couple senators that asked the top 25 endowments about the diversity of their investment managers. We reached out to our managers starting in July of last year and took until like February of this year to get all the information. And it was really informative what we learned from some of that, because some of them, the responses that they provide, it's very telling, and more so than we could ever get from, how do you treat your employees? It was really interesting, where the responses range from, UK firms can't tell you anything. In some firms will say, like, we don't think of it that way. We don't, think of people and their color or what have you. But people of color can't hide that. So they're thinking of it. And so like they can look around and see that the partners don't look like them. Like, you might not think about it, but they're thinking about it. And just telling us that you're not thinking about it is really informative to us, not in a good way. And so it's interesting to hear those responses. One of our funds said to us, we go to Harvard and we try and hire diverse candidates from Harvard, and a big firm comes in and offers them more money and they go to the big firm. And I was like, well, that's a really interesting analysis. Like, we're not Harvard, we're the University of Iowa. So maybe go, not that the University of Iowa is like the most diverse campus, but like maybe go to a different university. Like, that's a pretty easy problem to solve, right? It's don't, there's a finite number of people at Harvard, go elsewhere. Just the way that they respond to those questions, like, first and foremost, like, over half the people didn't even respond, which is and we told them, if you don't respond, we're going to assume that this is not an initiative that you're worried about or that you're emphasizing. And John, who's my analyst, did it in a much nicer way than I would have done it. But we told him that outright. If you're not responding, we're assuming that you're 0% diverse. And I don't know if that's the case, but we just told him that's what we're going to assume. We've added that to our diligence process to how are you thinking about that? We had a hedge fund blow up last year, and I remember it was right around the onset of the Me Too movement that we interviewed that fund. And I asked them, do you have like a whistleblower policy for sexual harassment?
Hmm.
And they're like, what are you talking about? Like, we've got like 5 employees. Like we wouldn't have that. And I had already talked to our HR team, like a 5-member team is not going to have a policy. And
Hmm.
I knew that they wouldn't, but the way that they responded, I should have kind of realized like maybe their risk controls aren't as tight as they think. Looking back, you always have the 2020 hindsight analysis of it. But a lot of that stuff is just very telling in how people respond. And it's early in the questions that the people are getting from allocators. So I can only imagine that
Yeah.
the GPs will do a better job of answering the questions. It'll be harder. Like they'll be smart enough not to say like, yeah, we don't look at color. We don't think about it that way. Just kind of brush it off. They'll be smarter than that a year, 2, 3, 4 years down the road. But if they don't have any partners that are diverse, if everybody will say like, you got to start at the analyst level, like, okay, that's fine, but you're on a clock now. Because if 5 years later, if you don't have any partners or vice presidents that are diverse,
Yeah, you're going to
there's a
get
problem.
even more questions.
Yeah, exactly. And so I think they'll figure that out,
Mm-hmm.
but I don't know. And some people just might say, I don't care.
Mm-hmm.
And I think that's going to be tough for foundations, endowments, pension funds as well to invest with those folks. Family offices wouldn't have a problem. They wouldn't have an issue necessarily with that. I think it'll evolve. I think it has to, because we look at it from our perspective, like internally, we know that we need to make changes, and we need to create an environment at UICA that's inclusive of all people. And so if we know we have to do that, I expect you as a GP that's for profit and makes a lot more than we do, you have to recognize that too, and you have more resources than we do. So if we're dealing with it, then you have to deal with it.
So it sounds like you guys have kind of come to the recognition that ESG, DEI are very much tied to investment performance, investment risk.
Yep.
And that while we are at the beginning stages of addressing that as an industry, you expect that evolution to continue. And that's something that you're watching and asking for in your process.
Yeah, I would hope the evolution continues. What I would expect is that if it doesn't, the firms that we partner with are the firms that do evolve, because we think those are better places to work. And I think the smartest people will want to work for great
Sure.
places to work. And
Yep.
so I see, so even if it doesn't evolve, I think our portfolio probably will evolve.
Yeah, no, it'll be good to kind of come back to you in a year or 2 years and kind of see how this conversation would have changed by then.
Yeah, and one of the things that we've learned from talking with other allocators is the way that you measure it is so it's just so gray. I was talking with a peer that said we just throw out all non-US managers because, like I said, in the UK you can't answer that question. And then you like we've had this debate, like if you hire an Asian team out of Asia, like is that diverse? Or is, based on US definitions,
Sure.
it would be diverse. But if you hire folks in China to manage a fund in China, like that's not like, so in some ways you could argue like you wouldn't want diversity. I don't know the way we define it, I guess. We even showed our committee when we got the data, like the number is X if we just do it based on market value. The number is X plus Y if we do it based on market value plus uncommitted capital. And the way you invest will change those numbers. So if you do a lot of index investing, those don't tend to be diverse firms. If you do a lot of private equity investing, it takes so long for that capital to be called that it really won't move the needle on those numbers. If you do hedge funds, you can really move the needle quickly, or long only funds that are diverse. That's how you move, capital called all at once, basically. That's how you move the needle quickly if that's your objective. So I think we as allocators have to figure out how are we going to measure this stuff, and how are we going to compare ourselves to others? Because if TIAA Nakubo study asked for this information, we all have to be on the same playing field when we present that information.
Yeah, that's definitely one of the biggest hurdles to kind of implementation of DEI is simply data and measurement. There's a lot of lot of talk about that, at the asset manager level, within our ESG responsible investing groups. And hopefully it comes with in partnership with allocators, right? Kind
Yeah.
of what's important to them, what they want to see from us as their investment manager partners. With the last few minutes that we have left, Jim, just a few things about yourself and about Iowa that you can share
Sure.
with us. Is there anything that you can tell us about yourself that we might not pick up on or know just simply by looking at your LinkedIn profile?
You wouldn't know that for most vacations. I mentioned to you before we got on the call. I was in Ohio over the weekend. I did a 100-mile mountain bike race in Ohio. So most of my vacations I describe as doing stupid things on bikes. Last summer I rode up Pikes Peak and Mount Evans. I think the only two 14ers in Colorado that have roads. So you can't
Wow.
tell that from my LinkedIn profile, but I'm on bikes a lot.
Okay, well, I can see how that risk-taking aptitude comes in with the mountain biking that you just described. Very cool. And then just about Iowa, since a lot of us have not been to Iowa and specifically Iowa City, are there any top three things we must come for to visit?
Yeah, yeah. Don't come in January or February unless you have like a really thick coat because it is very cold. But the top three things I would say, the nation's largest skate park recently
Wow.
opened and in Des Moines, the Lordson skate park in Des Moines. They had the Do Tour was there where they helped figure out skateboarding is a
Yeah.
Olympic sport. So the Olympic
Oh,
team was chosen in Des Moines, Iowa. And then also Des Moines, not for probably 2 more months, is the Iowa State Fair, which you can get anything fried on a stick. One of the highlights would be a stick of butter fried. I've never had it. Not very healthy.
we're gonna say it's like fried corn, but fried
You could
butter.
probably get fried corn, but that's pretty healthy. That's a vegetable, so that's on the healthy end of the spectrum there. The other, like RAGBRAI, which is the Register's annual Great Bike Ride across Iowa, takes place in July. That's I think 350 miles. They take 7 days to go across the state. But Iowa City, more close as I mentioned, I'm a cyclist. RAGBRAI, UCI, which is the governing body of cycling. There's a World Cup, which is the highest level of cycling, cyclocross event in Iowa City, one of two places in the United States that will have that level of cycling. I think it's September, mid-September-ish, or maybe October-ish. It's called Jingle Cross. It's typically held in December,
I
but
was
they
gonna
had to
say
move it
around
up.
Christmas time,
Usually
holidays.
it's around Christmas time, but to fit into the UCI schedule, they wanted to do it in September. So there's a lot to do in Iowa.
Yeah, sounds like it. Well, certainly a lot of places to go cycling, it sounds
Yeah.
like, Jim.
We have the second most gravel roads in the country of any state.
Okay, well, bring your bikes, everyone. Meet Jim. Well, Jim, thanks again so much for your time today. It's been really nice getting to know you and certainly learn more about how you think about investing, especially in today's markets. And, hope to stay in touch. And I hope as people watch this interview, that they also get some good ideas from what you shared about how to think about investing. So thank you so much for your time.
Thank you.